Good morning, everyone. Don't worry, we're gonna talk about oil. I see that already in the chat asking about oil. What's gonna happen? Are we gonna talk about that? Absolutely. We're gonna talk about oil. We're gonna talk about the market. We're gonna talk about certain areas in the stock market that look really good right now, where there's some opportunities. We're gonna talk about precious metals just a little bit at the beginning. Got a lot of stuff to get through today. So to start it off, I wanted to, Kashop just mentioned to me he's finally back home after all this time. It's been 5 months. Can you tell us a little bit about your trip? Like I know people in the States, they don't know what's all going on out there. I mentioned it the other day to a buddy. We were talking about gas prices, and they were like, yeah, it's crazy. It must be crazier here than anywhere else. And I'm like, actually, no. Like, basically, there's gas lines like in the 70s in certain areas around the world currently. So we were seeing things like that. So people in the United States don't really understand what's all going on out there. So, you've been traveling around, you're actually around Asia. So what's going on currently? You're back home. How'd that trip go? Where did you start 5 months ago, and how did you end up back home today?
So 5 months ago, I'm from India, so I went back for personal reasons, and then I was supposed to fly back in March, and then the war started, the flights got cancelled, and then pretty much everything was up in the air. So I took the time to take the pulse of Asia. I mean, it's not like it was a grand plan or something, it's just the way things worked out. So I went to Sri Lanka, and that's where the fuel shortages, the fuel crisis started to hit, and then the power crisis started as well. And then I went to Thailand to look at Phuket specifically, and it was okay. It was actually having a surprising tourist boom, and I like the market. I love Thai people, and I mean I think they are very friendly. Love the culture, love the place. Looked around, saw that pretty much inflation was sky high, and thanks to the jet fuel prices, there weren't as many tourists around from Europe as they usually are. And then I went back to India, and India is having this huge crisis with the LPG cylinders. So LPG is what people use for cooking. So the commercial cylinders are pretty much out, and the residential ones, I mean, you have to pay a huge premium and get it in the black market, because the regular supply you just can't get it anymore because there's a huge shortage. And then uh, I go back there and I see almost on a daily basis there's a petrol price hike. And then I'm like, okay, things are getting serious here. And now it's summer as well. So in summer, I don't know how much it is in Fahrenheit, but then the temperatures go as high as 45 degrees Celsius, which is as hot as it is here in Dubai. And then people turn on their air conditioners, and because there isn't enough electricity to go around, so you have a low voltage power situation, meaning half your appliances don't work, the rest work on a minimal setting. So it's been really tough in India. And then luckily the flights opened up, and I had a flight which was pre-booked since months ago. So I just took that and I came back home, and it's been great here actually. Like the one thing is you don't see too much traffic, and that's because it's the summer season, school is over, more or less over, so everyone's just moved out. So what happens in Dubai during the summer is pretty much everyone, the residents leave, and then they come back end of August. So it's like a quiet period. And now because of the war, it's like a little even more quieter. And frankly, I love it because all the deliveries that I need, instead of taking 30 minutes, it takes 20, but everything else works. So it's beautiful. It's like the city has emptied out and rolled out the red carpet for me. So I love it here. And it's been nice to be back. It's like a crazy ride. And yeah, like a lot of disruptions. And seriously, a lot of things have been up in the air thanks to the war. But finally, I'm back and it feels so good. And let's see where things go from here. So I haven't really been seeing what's happening in the markets as keenly as I follow it. But yeah, I mean, like, what do I see on my screen? Everything is at all-time highs. Every day there's some piece of news which sends oil lower, and there's some piece of news on the war, and it's got to a point where it's kind of got saturated, like everyone's talking about AI this, AI that, Trump this, Trump that. And I'm like, man, I'm tired of this news. Let's just tune it out. So I think you bring up the perfect chart to tone it out because 5 months back, uh, everyone was talking about silver and or everyone was talking about gold, and almost no one's talking about it now. And all we have had was a little correction in terms of price and time. So I think it's time to just ignore the noise around semiconductors, memory, AI and whatnot, and focus on the real trends, which is what is working, which is commodities, and what should be working and is not, which is oil. So, yeah, let's talk about that on this show. I think that's the thing everyone's going to be most keen on hearing from us today.
Yeah, I mean, everybody's probably wondering about oil, what's going on, and we're going to get to that, and that's going to be later in the show because there's a lot of areas that are working interest, and not to mention this is one that I know everybody's been interested. People keep asking, what is going on with precious metals? Are they going to ever go up again? Are they just going to be choppy, sideways, boring? There's a million ways to think about precious metals currently. And I'm sure Kashab probably is very similar to me in the same sense where I'm like, it's not the fact that I think that precious metals are done here. It's the fact that it wouldn't be surprising for me to say they're going to take a break here. I wouldn't be surprised to see silver go sideways for a while, gold go sideways for a while, and maybe energy, maybe these other sectors continue to catch up to it. Remember, people, gold made a huge move. You're talking to like it's one of the biggest markets in the world. It's the probably I think it is the biggest commodities market in the world based on market cap. And so if we look at gold, we're basically looking at this huge move that happened from 2000 all the way to 5500. Now it's pulled back to around 4500. I think that makes perfect sense. This thing should slow down. Nothing goes straight up forever. And especially as these other commodities start to catch up, you usually see gold slow down for a little bit. Silver is the same thing. All these precious metals are going to look about the same. So once again, also another thing to think about is real yields. As real yields are rising, usually gold doesn't like that. And that's kind of the scenario we're in currently today. We're starting to see a little bit of a rise in real yields. If those really start to break out to the upside, that's going to put a lot more pressure on gold. So, a lot of people keep writing in to me and saying, oh man, if you think yields are going to go to 10%, now I don't know if yields go to 10%. I said that that's a possibility. Now everybody's kind of saying that's me. That's fine. It could happen. But people say if you think yields are going to go to 10% in the 30-year, what does gold look like? Man, that's going to be crazy. It's going to be like $10,000. And really, like it depends on the inflation rate. One, it depends on real yields. And then it also depends on the fact of if gold can sustain in that type of environment. Like, I don't know if gold can sustain in that type of environment. Also, if real yields will actually be falling in that type of environment, that would be very surprising to me. So, looking at it here, if yields continue to break out to the upside, everybody's going to point to, well, TLT came back a little bit. It had a couple green days. Yes, we had some green days in TLT. Nothing goes straight down. That's going to happen. But in the long run, if yields keep rising and TLT, meaning long-term bond prices, keep going lower, I think we're in a scenario that it's going to be very tough for gold and silver to really rally here. So Kashab, what do you think about gold and silver? I'm wondering your angle too, because I'm not exactly bearish on it. That what I said sounds kind of bearish, but I'm not exactly bearish on it. Open to hear your views because long term, I still think it probably is higher. Short term seems choppy. You let me know what you're thinking.
So, when it went parabolic earlier this year, I always said that, I mean, parabolic moves don't last because you cannot keep increasing the rate of change, right? At some point, you're going to run out of buyers willing to pay those high prices, and that's precisely what happened. Now, the first correction that we got was sharp, but it did nothing to dampen sentiment. Like if you went on FinTwit at the time, people were still talking about how China is going to restrict silver exports and how there's a frenzy of retail buying in Hong Kong and all these other factors which were supposed to be good for the silver price and by extension the gold price. And yeah, I mean those are typically the kind of behaviors that you see during the parabolic move. Like everyone is buying the parabola, which is exactly why it happens to be a parabola. And we are seeing the same thing in memory stocks right now. So if you look at what it meant for silver, it meant that we were going to get a correction, not just in terms of price, but also in terms of time. Because once you have a correction in terms of time, that's when sentiment can truly reset. So that's what we are seeing right now. And this is also, if you look at the seasonality factor, the summer months tend to be pretty weak for the precious metals and then they pick up later in the year. So I think you have a convergence of the seasonality plus the sentiment sort of getting reset. Plus, you also have the war related uncertainties. So, what's happening is not for silver, but especially for gold. We are seeing quite a bit of selling by institutional investors, particularly in the Middle East. You're seeing selling by central banks like Turkey and Russia. So you're seeing all these actors who are selling it not necessarily because they don't believe in it, they are selling it for liquidity reasons. So that's kind of putting a dampener on the price. And if you look at what's happening in India, which is the biggest consumer market, second biggest consumer market for gold after China. So if you look at what's happening in India, India is having a sort of a foreign exchange crisis because India is an oil importing nation and oil prices are going through the roof. Not the oil prices you see on your screen, which says it's at $80 a barrel. No, that's wrong. The real price is probably 160, 180. So India, as an oil importing nation, it's suffering through a sort of FX crisis, and the government has taken steps by trying to curb the import of gold. So that's also leading to lower demand. And all these factors put together, we are having a correction in terms of both price and time. Now, here's the thing, the underlying bull case for gold, the fundamental case for gold, which is central banks keep printing the money that you own, which means you either have to invest it in, say, treasuries or some kind of fixed income instrument for yield, or own real hard money like gold and silver, which will give you the price appreciation to offset that depreciation. So that fundamental case, that's not disappearing. In fact, the new Fed chair who's coming in, he's probably a lot closer to Trump than the previous chair, and he's going to print. And the Fed is already sort of printing in terms of the reserve management program. So instead of calling it QE or money printing, now they are calling it RMP, and they're just printing. So the underlying cases for owning gold and silver have only strengthened. And if you look at what's happening with, the threat of sanctions against Oman most recently, or the threat of sanctions against China for buying Iranian oil or something like that, like it just weakens the case for the petrodollar. Like, why would people need to hold so much dollars when is being printed by a government that is hostile to them? So, in that situation, there is sort of a case to be made for more institutional. So, you and I are not going to think in these terms because the government is never going to come after us as individuals. But an institutional investor, this is how they think. What is the geopolitical risk they are taking? What is the risk they are taking by owning these dollar based assets? And then they are going to be like, let's rotate some of that into gold and silver to reduce that risk. So you're seeing the underlying strong, the current, so to say, it's actually in favor of gold and silver. But the tide right now is going out, and for all these factors, it's going out, and it's probably healthy that it goes out. Now, personally, in my case, I have added to my gold holdings. I haven't sold any of the gold or silver stocks that I have been recommending in the newsletter. In fact, I'm looking for an opportunity to, like maybe we get one final flush and then I can buy the stocks that I could not buy when they went up 10x in the last run. So I'm looking at those opportunities, and I think those are coming. And I think it's really really good if you're a precious metal investor to see this correction, because you need this correction in terms of price and time to have a long-term bull market. Because if we did not have this, the move would have probably exhausted itself early. But now that we got this sort of reset, we can have another 2 years of a bull market followed by the next parabolic move and correction, and then the next bull run and correction. So you can have a healthy long-term bull market once you see these kind of corrections. So as someone who expects to invest in precious metals for my entire lifetime, I think this is really great news for me. It's not so great news for the guys who bought the top and then kind of freaking out. It's not great news for the guys who bought some of those mining companies which were trading at absurd valuations, and now they are like, oh, what do I do? The stock is taking an 80% hit. Well, yeah, if you study the HUI index or any the Philadelphia, the Gold Bucks index, or in fact any of these ETFs, long term you can see quite a few of these 50-80% corrections. The key is to make sure where you buy and where you sell. So this is the time where you hold. I think the time to buy comes soon. The time to sell was in January if you were so inclined. I wasn't so inclined because I think we are going a lot higher, and I'm not really concerned with the interim peaks and valleys. So that is my approach to it. And if you did buy those tops, just hold on. I think we are probably going to get to a stage where your patience will pay off.
No, I totally agree with that. I think it's going to be the long run. I still am bullish on these, and it's just the short term. I'd say, hey, we're probably going to have some volatility, but that also leads to opportunities. I think that's going to be important. But there's a question for you here. What do you think on the gold to oil ratio? Basically, they're talking about the fact that the spread kind of got blown out. So obviously, gold was winning for a long time, and now oil is winning, which, yeah, we can see that. He says, like I was so big on gold, but the spread got so blown out. I think we need oil to rise for gold to continue higher. I wanted to pass this question to you because it's actually more complex than what most people think, and you're a good person to talk about this. So, what about the gold to oil ratio? Do you think that gold for gold to continue to rise, it needs oil to rise with it? And maybe you can explain why or why not that should or shouldn't happen.
So if you look at the real oil price, not the price that you see in your future screen, so I strongly believe the futures price is being manipulated. So if you look at the real price, if you look at where physical barrels are trading, I would say we are already seeing oil prices rise. But when you look on your screen and you see this financial product, every day there is some news by Axios or some other fake news channel, and they say deal is very close. And then
Mm.
even if there is no deal, the algos do their work and send oil down 5% and stocks up 2%. And this has been happening for so long now that these contracts are basically duds. You cannot use them for price discovery. You can use them the same way you use Polymarket or some other sports betting site. That's all they are. So I would say the gold oil ratio itself is broken, and as long as it is broken, there is no point in running statistics on it. So we need to wait to see if, let's say, we can get the prices of actual barrels that are loaded on actual ships for delivery. And we get those and we form a futures curve out of those, and then you make a gold oil ratio out of it. And then, you do some analysis on that. Then, yes, I think that makes sense. Whereas using current WTI, current Brent, none of these contracts reflect reality. So I think it's best to just stop using them. And it's the same case with the free futures as well. So if you look at the rates that are being paid for transporting oil on ships, for instance, and you see a rate on your screen, which is the FFA rate. So I don't want to get too technical here, but if you look at that rate and then you look at, hey, none of these ships are loading cargo. So what exactly am I seeing on my screen? Well, you're seeing something. It's something which is being manipulated by someone, and you can get into the plumbing of it, the mechanics of it, or you can just be like, I know this contract is being manipulated, let me just get away from it. And there is a precedent for this. So if you go back to 2022, what happened with the nickel contract on the LME, it was being actively manipulated because one of the owners of the LME, in fact, was caught short in that trade, and nickel just went straight up. So what did they do? They are like, well, let's just cancel all the trades. That's it, and get out of jail free. So this is what they did. So, and if you go back and read futures traders notes or trading journals from the 70s and 80s, you can see so many points where these contracts were actively manipulated. It is just that we have gone to a stage where we accept what we see on the screen as reality, and we are not that discerning anymore because the trust in institutions has risen, whereas it should not be rising in times like this, because during war times especially, there is always a always something is being done to manipulate the perception. So right now, instead of focusing on all the things going wrong with the economy, Trump wants you to focus on semiconductors and Dell and all these things. So that's where people focus, whereas in reality, what's happening is something else. And it's the same with oil. So in fact, I think it was the CEO of ExxonMobil who came out recently and said, as soon as these SPR releases and all these games that are being played with the oil price are done, we are going to see a move straight to 150 or 160 and then onwards from that, because he predicts that the current inventories that we have won't last for even 2 or 3 weeks. And it's such a scary news. It should be front and center on headlines everywhere, and you can barely find it anywhere because that news is getting suppressed. So ignore the gold oil ratio right now, or conduct a custom indicator, because this price that you see right now is not going to help you in any way.
Yeah, so and also the other thing I wanted to add too is, if we look at it just as in the gold, like do we need oil to rise for gold? Oil being up starts to put pressure on gold at a point because we need gasoline, mainly diesel, to move metals out of the ground. So then you start to see that eat into the bottom line for these gold producers, even though right now, like they have a lot of wiggle room. The gold price being up so much really creates a lot of wiggle room, but sometimes you can see the oil price starts to put pressure on the gold price. So that's also something to keep in mind on top of what Kashop mentioned. So if we're looking at gold, really that's the main level we're looking at on the spot price in the US, 44.68. So if we basically hold above that level, that's the main level. That's fine. I'm not a big believer in like, oh my gosh, it went under this level. It's the end of the world. I think too many people make like support and resistance zones into like being like, the word of God or something. Really, it's just, hey, we have this zone here. And really, what they always tell you in technical analysis school is you need to use a marker, not a pencil, when you're doing support and resistance zones. What that means is that this is the zone. It's not just this little line, it's not just this price. This is the zone. So basically, anywhere from 4,500 all the way to 4,300 would kind of be the zone that we're looking at. And then also, I also always qualify that with weekly closes. If we get weekly closes, below 4,300, that's probably going to be bad. But that's just the technical view of it currently. Long term, I still do think that gold is probably going to even go higher, just as Kashop mentioned. So, Kashop, before we get to more about oil, because I brought a few charts on oil as well, let's talk about emerging markets a little bit, the dollar, how this is all going together, because we're seeing, emerging markets keep ripping, and we're mainly seeing right now a lot of the technology-based countries working, like whether it's Taiwan, China's, oh, sorry, not China. China doesn't look as great right now. Over the last month, they've kind of picked up again. But any of these countries in Asia that are really tech-based are doing really well. So what do you think about that currently? Do you think the emerging market trade is alive as well? Do you think the technology emerging market trade is more alive than the commodity emerging market trade? I'm curious about this because we've been talking about. I've been very bullish on South America. You've been talking about Africa. So our current commodity countries have slowed down a little bit, but the technology countries are winning. But that's just short term over the last month. So what are you thinking about that? Do you think that's going to continue, or do you think that ends sometime soon?
So if you look at the South Korean stock indicators, so the Kospi index, or if you just look at the charts of Samsung and SK Hynix, I mean, it's clearly a blow off top. It in fact it doesn't remind me of anything other than Bitcoin in 2017. So Bitcoin in 2017, you had this nice sort of smooth move from $1,000 to 13, $14,000, and then it was a straight vertical candle, within a week or so to 20K. And it was just pure mania because there were no pullbacks. It was just buy, buy, buy. And at the end of it, it fell all the way to $3,500 during COVID. So it was a long decline. So that's the thing with these big moves. So now Taiwan is sort of a small market, like 40% of the index is just one stock. Korea, not exactly a small market, but still dominated by two names. So, you cannot really make too many predictions based on a very small market, because small markets can stay crazier for a longer time than larger markets. So, and Asians love to gamble. So this is the reality. And right now, everyone is pretty much all in on these stocks. In fact, you're hearing stories of people cashing out their insurance or selling their blood, selling their blood plasma in order to get money to put into Samsung and SK Hynix and things like that, which is sort of crazy. But I mean, that's exactly what you see during the mania phase of a bull market. And we have been here before. So the other example I bring up often in this regard is 2014 China. So 2014 China, no one, so 2013, 2014, you remember this period, no one wanted to touch the S&P. No one wanted to buy Apple, Microsoft, all the tech giants which are so popular today. No one wanted to buy those stocks. What did people want to buy? They wanted to buy Tencent, Baidu, Alibaba, pretty much all the Chinese stocks. And the reason for that is there was this rumor going on that MSCI would include Chinese stocks in a big way in their indices, and therefore institutions would allocate more to it. And because there was sort of a tech bubble going on in China, everyone was like, it's exotic as well. So everyone was like, let's buy these big Chinese companies regardless of valuation. And there was this screenshot from that era where you saw a banana vendor on the street with his laptop buying stocks while selling bananas. I mean, that tells you the level of sophistication or competence of the people who were participating in that market. Then the bubble burst, and for 10 years, Chinese equities went nowhere. So I think it's something similar to what we are seeing now. We are seeing this big blow off top in South Korea and Taiwan, and it's a smaller market, so I wouldn't say we're going to have a 10-year bear market or something. And AI as such is a real technology, so I wouldn't say we're going to have that long a correction, especially because there's more money printing going on right now. So I would just say it's a parabolic blow off top. Avoid those two countries, focus on where the value is. So even let's say you do prefer Asia. Right now, India is in the news. No one likes India because they're probably going to devalue their currency. Okay, great. We saw a similar situation with Sri Lanka in 2022. Then they devalued the currency and then the market picked up. So you wait for that event, and once you have that event, then you pick the stocks in the country. Or you look at Thailand. So it is really kind of a shocking thing to me as well. Like, until I went to Thailand, I did not realize it. The Thai baht has been strengthening against the dollar
I have
at a
seen that.
time at a time when almost every currency is weak. And someone brought up Brazil, and there's a real risk that even the Brazilian real will devalue. But you look at the Thai baht, and it is holding steady. It's in fact increasing, and the reason is Thailand is doing a big focus on data centers. So they have something called a board of investment or something. And what they're doing is they're allowing a lot of foreign investment to come in specifically to build data centers in the country. Now, that's a use case for AI, which is not captured in Thai equities. And you look at the market overall, you get big fat dividend yields on their banks, and their banks are doing fine. It's not a crisis yield. It's not Deutsche Bank in 2014, trading cheap for the right reasons. So you have this situation where you have attractively priced stocks in an appreciating currency in an emerging market, which is being ignored mainly because everyone's focused on AI. So I would say if you're looking at opportunities in Asia, you look at India, you wait for the currency devaluation. You look at Thailand, maybe that's investable today. I don't know. You look at Hong Kong, there are tons of cheap stocks in Hong Kong now. The thing is, go back 2, 3 years, and everyone would say there are tons of cheap stocks in Japan, and no one cares because, yeah, they have been cheap for 20 years, 10 years, your entire career. And then what happens? And then you have this big move, and Japan turns out to be every day is an all-time high. Now, can the same thing happen to Hong Kong stocks? Yes, of course it can happen, because once the market discovers value, the momentum starts to feed on itself. So I think you look at, if you're looking at Asia, you look at these opportunities. you should definitely start looking at India right now. Yes, the situation is bad, but that's when you do your homework because
Wait,
once
wait,
you
wait,
have the
wait.
deval,
Kashab being from India, I have never heard him once say. Actually, he's
yes,
been the most biggest bear on India that I've ever met. And so, one time in history, we need to mark this down. Kashab is actually talking about looking into buying India. Okay, I wrote that. I'm going to write that in
yeah.
my journal tonight. Okay,
And
carry on. I'm interested to hear the India thesis.
yeah, so India, once they depreciate, it's going to boom. And even without depreciation, so you know what's happening with aluminum. So 25% of the global capacity has been taken out. So Bahrain and Emirates Global, which is UAE, the two of their biggest plants have been taken out now due to the war. So where does the where does the aluminum come from? Where it comes from India and Malaysia. So that's something to look into. So even if the currency doesn't depreciate, you have these niche opportunities. And in chemicals as well. So you have these niche opportunities. So there are all these sectors you can be looking at. And once you have this tailwind where they depreciate the rupee and the current foreign minister is seriously thinking about getting rid of these long-term taxes. So when me as a foreign investor, I invest in US stocks, I don't pay a tax in the US. There's a withholding tax on dividends, but nothing on capital gains. Whereas, Jason, if you go invest in India right now, they're going to charge you a tax on your profits, which is kind
Yes.
of, yeah, it's kind of crazy. Like Italy does it, India does it. And I think, correct me if I'm wrong, those are the only two countries which do it. So
Yes.
that has to change. So when that changes, then you're going to see capital move more seamlessly into the country, and that's going to be a catalyst. And also, India is unloved, and at some point, I start to love things that are unloved. Like I think the best year for India was 2022 because the world was in sort of a crisis because tech stocks were going down and Indian stock market was making all-time highs on a daily basis, and the banking stocks in India were looking like SK Hynix and Samsung today, which is crazy when you think about it. Like, when was the last time you would have had a mania in banking stocks? Well, India had it. Almost no one knows, but India had it. So it's wild to think about it, but those moves can repeat once you give them, a 4 5 year breather or a window where no one talks about it. So I think India will get to that stage. Thailand already looks super attractive. Hong Kong looks very attractive. I wouldn't say Japan is so attractive because it's on all-time highs on a daily basis now. Plus, any day the yen is going to depreciate. We have been talking about that on the show for a long time. So, I would say focus on these in Asia. I would still stick to my Africa call, and I still firmly believe in your Latin America call. So, I think these are definitely the places where people should look for value.
I do too. I think everybody's very short term, traders, and it's normal how human minds work. Everybody is, you'll underestimate what you could do in 10 years and you'll overestimate what you can do in a month. That's a normal human emotion. So if you're like that, of course you're not going to have that ability to really be like everything. Like, that's the reason why most traders have so much trouble, because they chase the next shiny object. You have this one thing over here, emerging markets, and let's say, really, let's be honest, it's semiconductors that are doing so well. So any of the countries that have a large semiconductor exposure, like South Korea, are really outperforming right now, or Taiwan. That makes perfect sense. So you start to see that, they start to chase the next shiny object. Okay, well, semiconductors are doing great. Let me dump all my money in this thing, and they'll forget about the things that have been trending for a long time, which Latin America has been trending, Africa has been trending. Yes, in a 1 month time frame, these other countries that are heavy tech countries are outperforming massively, but in a run time frame, if you're looking at year to date, you're still seeing these commodity countries are doing better. So once again, it's like you still want to have that long term view. If you do have these positions, that's great. I do have some of them as well. I am long semis, emerging markets, a couple other things that are very tech based. But at the same time, I still am long, Latin America across the board. I'm still long Africa. I'm still long certain areas that they haven't broken trend. And that's the thing. Like so many people are just going to jump to what's next. It's why beginning of the year, everybody's excited about energy. Now everybody's like, oh, it's over. It's dead. We're never going to see energy move up again. Another one here is rare earths. Rare earths were very hot this year. They started to move. They came back a little bit. You saw a false breakdown signal that's starting to move back higher. It's one I just wanted to bring up real quick. Nothing really to go over past that, but it looks like it's ready for another leg higher. And then uranium. Kashop's always been a very good uranium analyst, always kind of picking out the lows in uranium over the years. So I'm wondering what you're thinking about the uranium sector as a whole right now. We are seeing some of these alternative energies starting to move, whether it's solar, rare earths, any of these things in that area, lithium, any of the things in that area are starting to move. Do you think uranium's going to go with it, or do you think uranium's kind of dead money currently?
So, I have been out of the uranium space for a while, mainly because valuations got too out of whack and nuclear started getting associated with AI and it sort of became a mini bubble. So, I'm not very comfortable holding stocks that are in a bubble. So, I try to get out little close to the top, doesn't matter, but uh, somewhere there, and then I stay out until things sort of stabilize. And right after the war started, so a funny thing happened. So the war started and uranium prices went down. Why? I have no clue. Because if you look at the fundamentals, what happens, especially in this particular war, so you need a lot of sulfuric acid to get your uranium out of the ground. So similar to copper. And sulfuric acid is in a major shortage. Now, sulfuric acid was in a shortage even before the war for the biggest uranium miners. So Kazatomprom, which is Kazakhstan's national uranium company. So the shortage got to a point where they decided, hey, we are going to build a plant ourselves just to supply our mine. So, I mean, they take this major capex decision because they are dealing with the shortage of a key chemical. So that happened, and then sulfuric acid completely disappeared from the market thanks to the war. Not disappeared, like 25%, 30% cut, and uranium prices went down. So that was the opportunity. So I started buying at that point, and I think somehow the market hasn't really woken up to this yet. Copper has moved, the sulfuric acid shortage and its impact on copper. Now that's known. Copper has moved, but uranium surprisingly hasn't moved, and I think that is set to change. So I think if you aren't in this trade, this is still a great time to be in because the fundamentals are really supported. Now, the chart that you have brought up here, that's the uranium miners. I would prefer the physical metal to the miners at this point because, again, with the miners, you never know how they're going to get hit with the rising cost of diesel, power, or even the shortages of key reagents. So I would focus more on the physical metal and avoid the miners for now. Or if you really know your miner and you know they have their supply locked in, then that's a great buy because they'll be the only suppliers in the market which is heading into a deficit. So if you can do the research and figure out which are those good companies, then that's one way to go about it. The simpler way is to just buy the metal itself and just wait for the repricing.
No, that makes sense. And so, a couple things, and I'm gonna go over these real fast, and we'll jump to oil since we're getting a little bit low on time, and I want to give us some time on that. And so, copper miners, global copper miners, COPEX, and we are seeing like there's a lot of individual names. So definitely dig through the individual names currently, but there's a lot of individual names that look great right now. So copper miners are another one I want to highlight here today. Alcoa, you brought up aluminum. Um, aluminum is aluminum is looking really good. Whether we're looking at the actual metal, whether we're looking at the stocks inside of it. So, do you know any? I only know a little bit about the fundamental story on aluminum currently. Supply and demand numbers, I can look at that all day. I can get an understanding, but hearing a little bit about the shortages going on and so on around the world, and people basically being open to, like countries finally actually buying back aluminum cans once again, which was something that didn't happen for many years, is very interesting. So they're basically saying like, hey, we need more aluminum, and we're just not producing enough currently. And then we have companies like Alcoa, Cenex, and so on. These are all doing very good. So what are you thinking about aluminum? Do you think, do you know anything more about that story besides the aluminum can idea and random fundamental things? Because man, aluminum is taking off and it doesn't look like it's slowing down anytime soon.
So, 25% of global capacity is impaired due to the war. So, there were strikes on Emirates Global Aluminum, and I think it's Bapco, the Bahrain aluminum company. So, that's taken a big chunk of capacity offline. Now, you couple that with rising power costs, rising transportation costs, all of that, you are in for shortages. So that's what's happening right now. And funny story. So in India, we cannot get Diet Cokes anymore. And the reason is the other soft drinks, they come in these bottles, whereas Diet Cokes, it's sort of like a marketing thing for Coca-Cola. And they said, we have to be different, so we'll only do the can version of it. Now they can't procure the cans, so they don't sell Coke. So it's the shortages have actually gotten to a level where the everyday consumer can feel it. And it's only going to get worse because how do you replace 25% of capacity overnight? Well, you can't. And luckily for the US, you have all this capacity, you have the ability to import bauxite and smelt it, refine it, make the cans yourself. Whereas for Asia, for the Middle East, where this has all been outsourced and the supply chain, the global supply chain has worked in keeping prices low, that factor has got disrupted. So I think we are going to be in for higher aluminum prices. Now, here's the thing, once aluminum gets expensive, it's going to get substituted with plastic because that's just the way the supply chain works. Because not all products can absorb these higher costs and pass it on to the consumers. Sure, you're going to get some inflation, but you're also going to see a lot of substitution. So if aluminum prices keep going higher, we are going to get to a point where the demand is going to drop off. I don't think that point is here because we are so used to our canned food and our canned drinks, and pretty much everything comes in a can these days. So we are so used to that. But I think a year or two from now, this should change. It doesn't really matter right now. I think the bull market is good to go probably until the end of the war and a year after that.
No, interesting. I think it's an area of a lot of opportunities. Is the whole metals and mining sector. If you're looking at copper miners, you're looking at aluminum stocks, you're looking at steel stocks. Like there's a lot of money to be made there, and I think a lot of people are overlooking that right now. The dollar, I don't want to get too deep into the weeds on that because we want to get to oil. But we're looking at the dollar. It's basically, yes, long-term downtrend is still what I'm thinking. A lot of people keep asking, if it's bouncing, it's doing this, it's doing that. Yes, I know it's been in a range. It's not doing anything. It's in a downtrend, and it's now in a range inside of a downtrend. All I think right now is it's probably going to break down in that range because that's usually the highest probability bet. So now we're looking at commodities versus the 30-year bonds. You're also seeing that this is just ripping to the upside. Most of the time when this happens, you're going to see bond yields move up with it. A lot of people keep asking me this question about bonds. Hey, they bounced recently. If you're looking at bond prices in TLT, see a little bit of a bounce. Everybody gets excited. Everybody's happy about it. Oh my gosh, I'm gonna be long bonds, and I'm gonna be the next bond trader, the bond king, whatever the hell you think you are. However, the intermarket analysis, the yield curve, everything is still pointing to higher commodity prices, lower bond prices, and there's not a scenario in the world where you could say, yeah, oil's going to, even if oil comes down a bit, let's say oil stays at 80, 90, somewhere around those levels. We're still looking at that putting a lot of pressure on bonds. So I would still say stay out of being long bonds currently, basically across the board. They don't look good anywhere currently. And so energy, we're looking at energy here, and I want to ask a shop. There's these 6 different areas. This is what I found interesting yesterday. So primary trends, if we're looking at it in a short-term view way, which is the 200-day moving average. I don't know how that got a little space there, but I'll fix that later. So, oh no, that's right. Never mind. Anyways, so the 200-day moving average, where every sector is above the 200-day. Every sector is below the 20-day, and most of the sectors are below the 50-day. meaning it's hanging on to the primary trends. And as you can see, just looking at the charts, the primary trends look fine. Nothing looks bad about any of these. But I'm wondering, going forward, because a lot of people look for dip buying opportunities and so on. I'm not one of those guys, but I know most of our readers are. So if we're looking at, anywhere where you'd see an opportunity out of these 9 sectors, where do you think like you would position yourself? Because this question comes up a lot, and I'm like, you're the perfect person to ask this to. So out of all these sectors, what do you think is the one that will really lead the way going through the next year?
So I would avoid XLE mainly because it's too large cap. So you're not going to get the kind of upside that you would expect in a big move when you're buying the large caps. Now, if you're buying it in a retirement account and you're sort of calling a rotation, so if you go back to 2011 and you said, I'm going to take some of my retirement account holdings, remove it from XLE and put it into XLK, so moving it from energy to tech, that has been a great rotation call. So if you're doing something like that and you're saying, I'm going to sell some AI and I'm going to add energy to my retirement account, then I think XLE is the perfect vehicle for that. Now, if you're more short term, if you're trading, I would look at the oil refiners because crack spreads, which is what they need to really make money, that's going to go through the roof. So I would look at the refiners. Plus, the refiners also get this subsidy from the government. So the SPR releases, I don't want to go too much into the detail on that, but the SPR releases, it's like a very low interest loan that is being given to these refiners. So they're going to benefit from that. So I would look for opportunities there. I would avoid MLPs mainly because it's a tax headache. So it's good if you're a US based investor. If you're outside the US, just avoid MLPs altogether. Infrastructure is going to get tied to the AI trade. So I would use it as a proxy for AI, but not exactly for the core energy thesis that we are talking about. So it's a toss up between oil equipment and small cap energy, and I think small cap energy wins because what's happening, especially in the Middle East, is a lot of these offshore contracts are getting cancelled due to the war. So that's going to have an impact on the oil services industry. So I would skip oil services and just go with small cap energy because small cap energy you can find some really good values, and especially if you're buying something which is US based or Canada based, then your asset is safe. Whereas if you're buying these oil services, your asset is not exactly safe. So for the safety factor and for the valuation reasons, I would pick small cap energy.
No, that makes sense. I think it's an interesting time, and there's so much going on. And the one question that came up here, I wanted to answer real fast when it said, "When is a good time to buy bonds and hold till maturity and capture yield?" So once again, trading is going to be different than wanting to invest in something like bonds long term. Also, in my opinion, now I'm not your financial advisor, and this is not financial advice, but I can tell you what I'm doing. I'm not putting any bonds into any of my retirement accounts. I haven't been doing that since 2020. Um, and yes, if you want to buy some short dated bonds, capture a yield, especially if you're holding a lot of cash, fine. I don't see anything wrong with that. I just think at the same time, there's probably a much better way to put your portfolio together than being allocated to something that's going to get hit every time there's an inflationary environment. You want to capture yield, buy energy stocks. There's a lot of yield there. You capture a better yield within something that's within an uptrend. Now, if you have to allocate to bonds, let's say you're a financial advisor, you have a portfolio that has to allocate a certain amount to bonds, go as short dated as possible. The longer term maturities, yes, they might have a higher yield, and yes, you might be more interested because of that. But at the same time, the price is going to get hit much more than those yields are ever going to make you any money. So I'd go short dated. That way, the price, if it fumbles around, it isn't going to fumble around an extreme amount like the long dated bonds. And you're going to make that yield. I wouldn't recommend, for myself, I wouldn't recommend any of those things for myself currently. So I'm not doing any of that. I think there's better places to be, even if you have to run a retirement account. There's much better places to be. So moving on to this chart, then we'll hop out of here. So looking at the 30-year yield, speaking about bonds, looking at the 30-year yield in oil. Now, once again, as Kashop mentioned, futures price. But if you look, and this is something you might want to look at, Kashop, when you're thinking about what I see happen a lot in the futures market is things get manipulated in that front month contract. So if we're looking at that front month contract, we see a lot of manipulation every time. Up, down, oil price goes negative $50. It's only the front month contract. It's not the rest of them, and so on. So if we're looking at something like this being the front month contract, that's one thing. But if you look at the December contract, you get a better understanding of what's actually going on in the market. So people out there try to look at the longer dated contracts. You'll see kind of what exactly is going on with oil. And currently that's the one I'm trading as well as December. And I like to be a little bit further out because short-term contracts, when they're the front month contract, they get hit by the news like crazy. Up, down, sideways, whatever it is, they're going to get hit by the news. The longer dated contracts are mainly going to be very stable. For example, you get a 10% down day in oil. I'm looking at more like a 2 or 3% down day in my contract. Some days those contracts end up positive while the front month contract is negative. So that's a huge spread between the two. But that usually tells you that over time, the price is going to look more like that December contract and not like the front month contract. So looking at this spread, I want to ask you, where do you see yields really heading? This is something that so many people have thoughts on one way or the other. Either yields are, and nobody's just being objective about it, because nobody wants to just say maybe they could be range bound and annoying for a while. Everybody wants to say they're either heading back to zero or yields are heading to 10%. And there's not many people in the camp that it's heading higher. Even though everybody keeps telling me there's all these people talking about how bearish they are on bonds. And I'm like, well, I know about 5 of them total. And everybody points to the contracts. They're like, see all the short positioning. And I'm like, well, once again, understand the basis point trade and you'll understand the way those are positioned and the reason why. So I want to ask you, what are you thinking about yields? I know what you're thinking about oil. We did talk about that a little bit earlier. But what do you think about yields? Do you think yields are going to continue up? Do you think oil is going to continue to put pressure on it? Or do you think that this is a situation where all of a sudden yields are going to start to fall the other direction? Because, I know we've talked about possibly having like a recession, something happening going forward. So what do you think about yields long term?
So if you at the start of QE, so that's after the 2008 crisis, and really if you around the 2011 the EU crisis, the yields in pretty much all these European government bonds, they went to double digits, so 12%, 19%. So it got crazy, and then the European Central Bank came and said, we are going to do whatever it takes to bring yields down. And then they're like, we are going to do unlimited money printing. And then they said, whatever interest, so instead of paying interest on bank reserves, they are like, we are going to charge you a penalty for keeping bank reserves, go out and lend. And that kickstarted a sort of bull market in bonds, which ended with European yields going negative, meaning you are paying them 101 euros, knowing that you will only get back 100 euros at the end. So you are okay with taking a capital loss just to lend money. So we got to that kind of craziness, and then it reversed. And then you got to the opposite level where, yields are now touching 5% and no one wants to buy bonds. And here's the thing. The Fed was printing money then, the Fed is printing money now. So what's really changed to completely do this U-turn in the bond market from people willing to accept close to 0% rates to people now saying 5% is not good enough? And I know you have brought up the chart of the US 30-year, but if you look at UK, EU, pretty much across the globe, the chart looks similar. So that's why I'm using this example. So the reason this is happening is because inflation expectations have been permanently reset. Now, you go back to 2019, Janet Yellen says, hey, I'm worried there isn't enough inflation, that we have printed so much money and we don't have any inflation to show for it. And then COVID starts, they print even more money, and then the inflation turns up. and then they're like, oh no, this is transitory, and then they try to cover it up. 2022, we sort of peak at 9% inflation, and then it starts going lower, but it never goes negative. Now, if you have a period of above 2% inflation, you need to see a period of below 2% inflation, meaning you need to see deflation in order to reset the CPI back to where it would be with just 2% steady inflation. So we did not see that. What we saw is inflation plateau at a permanently higher level. And now with the energy crisis that's going on, that level is going to just keep increasing. Now they can say we are going to remove coffee from inflation, and Wash has come out and said, the new Fed governor has said, what if we take all these high inflation values and the low inflation values and eliminate them from the CPI? And I mean, you're going to get inflation down. The official number that you print will go down because you're eliminating the highs and the lows. Yes. I mean, there are no lows, so forget that. So he said that, and that sort of statement from the central bank governor doesn't exactly provide confidence to the bond market. Now, the guys who are buying bonds are buying it for retirees, who are buying it for people who are on a strict pension. So those are the kind of buyers, the conservative buyers. They're not the guys who are going to YOLO their life savings on zero DTE calls. So these kind of buyers, when they see this kind of rhetoric from the Fed, when they see 5% inflation, 4% inflation get normalized, when they see that the central bank over a pretty long period of time has done almost nothing to fight inflation, well, they're going to start demanding higher yields. Now, it also will get worse because, especially for the US, not so for other countries, but especially for the US, treasuries are owned by people all over the world. Every guy holding, crypto YOLO guy holding USDT, the USD Tether, he in a way is participating in the US bond market, the treasury market. So treasuries are so over owned everywhere. And then you come out and say, there's a news saying, hey, let's sanction Oman. Now, that increases the geopolitical risk of holding treasuries. Or with kicking Russia out of SWIFT, that increases the geopolitical risk. Or starting a trade war with China, that increases the risk. Or any threat to the petrodollar, which is seen, coming due to this war, that increases the risk. Now, also, all of this aside, you have the other factor, which is some emerging markets, particularly India, they really have to defend the rupee. And the way to defend the rupee is to dwindle your forex reserves, which are mostly in US dollars and mostly in treasuries. So when you see all this happen, the world has gone from owning a lot of treasuries to bringing the treasury holdings down. Now, earlier when they used to do that, the Fed would just step in and buy, QE, QE2, whatever program that you call it, they used to do it. Now they're calling it reserve management program, and they're not doing too much money printing on that basis. So who's going to own those treasuries? Not foreigners, not domestic institutions. Some of it, the shorter duration ones, yes, those go into the money market funds. And that's why the treasury is sort of trying to do a buyback where they buy these longer dated bonds from the market and issue shorter dated bonds. So they are sort of doing all those tricks to manage yields, but ultimately, these are just tricks. The fundamental reality is demand for treasuries as a global asset has diminished. And there is nothing you can do to stop it short of making the dollar and US treasuries more attractive. And the current administration is far from doing that. So, this is a trend that's set to continue at least until the end of Trump's presidency. So, I would just look at this chart that you're showing me, and I'm going to say yields are going to go higher, oil is going to go higher, and that's just the reality we need to be prepared for.
All right, guys, we got to end it right there. We will be on with you guys next week on Friday at 10 a.m. Eastern Time. I'll see you guys next week. Make sure to like this, share this, and subscribe to the channel. I do a lot of pop-up lives. We saw one on Memorial Day, or yeah, was it Memorial Day or Labor Day? Memorial Day. I always mix these days up. I'm terrible at dates and things like that. But anyways, just last Monday, I put out a video, so make sure you guys are checking that out. That was mainly about how to make money as a trader, how to make money as an investor, and how to make money as a human. So definitely check that out. Subscribe to Against All Odds Research on Substack. Also, make sure you're following Kashop286 on Twitter. You can also check out his channel. He's also got a great one as well. So, all right, guys, we got to run. I will see you guys later.
Bye, everyone.